What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online. Same as always. Today I'm going to go over the type of yields that I've been getting so far and what I think you can really expect on this platform in the long run. Now, when I say this platform, I actually mean several different ones. Uh, as far as the ones I put money on so far is Lofty, Groundfloor, and Mogul. I'm going to talk a little bit about each of those. Um, Obviously, the returns are going to be a lot different. The risk profile is different. And, I've only been using the longest one that I've been using is Lofty, maybe Ground Floor about the same amount of time. That's only been 3 months. Mogul is much more recent. And so, I have a lot less data on that, but I'm just going to share with you what they're providing. Um, but so one of the things I talked about when in yesterday's video, and if you haven't watched that, just talking about the two different strategies I'm using on Lofty. One of them is buying properties that aren't performing at all, trying to pick them up at a discount. But I've also bought some, and so I'm not going to talk about those today because I think it's too early to know how I'm going to do on them. I have actually bought and sold some of those tokens already. Some I bought and sold the tokens for a profit. Some I bought the tokens. We sold the property in real life, and the tokens are just the ownership. What stand for the ownership interest on the platform. And then got liquidate. So liquidated the property in real life and got a piece of that. And so both of those I've made actually decent returns if you annualized them. Um, but it's really early. Most of them, I show my account on here a lot, and you can see I've got all of these that aren't yielding anything from a rental yield perspective. They were like that when I bought them. I expect them. Some of them I think will turn around and start throwing off some income, but I think most of these are going to actually get pushed towards a sale, and I expect to get a big pop in equity when those sell. But there are several, like this one here. There's several that I bought that were truly just buying for a good yield, and I want to break down what we've got there. So uh, let's see. I put these all in the long-term rental category, which is silly because I shouldn't have the universal lending DAO in here, but it's about the same as the others, and so it is a long-term yield. And although what that is a little bit different, I did a separate video about that if you want to check it out. But in general, these are the long-term rentals that I have. And you can see their average return or their average yield is 17.8%. And so that is actually um, cash being paid out to me relative to the token price at the price I paid for the tokens. It does not take into account my full basis, so it's not taking into account um, the commission that I paid on the purchase. So basically, Lofty doesn't put all of your closing costs into the basis, and so it sort of inflates this yield a little bit. I think it's fair to take probably 1 to 2 percentage points off this relative to the amount that I actually put in. Um, Probably somewhere in between those two numbers. I'm not exactly sure. I have been tracking my basis, but when I put this together, I just pulled it from there. But in any case, these are very good cash on cash yields. Um, I think on top of this, some of these might provide, a little bit of long run appreciation, although, they're all in markets that tend to be quote unquote cash flow markets. Well, I say that they're not all. Andover is a market where I think we maybe could get some market appreciation. And so, in all of them, I think you get a little bit, but so your overall return may be a little bit higher, but I'm just going to talk about the pure yields today, just what the cash they're paying out relative to the purchase price. And so for long-term rentals, I've actually got much better yields. That you can see I have 3 short-term rentals. 90 Madison was doing much better before, but had a bad month, and so theirs fluctuates more. So at the moment, my average for those are pretty low. I think it'll probably double this month and be back up into doing a little bit better, and if not this month, sometime soon. But so so that those average, sorry, is 9.6, and then I did a combined average of the two. I'm getting about 14.74%. I mean that in any any investment that you can make, that's a fantastic current yield to get paid. Even if that's what I'm looking at. And so, part of this is that I have been pretty selective about picking up tokens when they're a little bit cheaper. So, for example, uh, this Kansas City property here, their market price has been in around 50 most of the time, but whenever it's sunk, I've picked up some. I actually think I did a video on that when I did it. I got some as cheap as $42. Some were higher. I think the highest I paid for any of the tokens were 48. And so, um, by doing that, by identifying properties and then buying tokens when they're cheaper, I think, I'm getting a slightly above average yield than if you just logged in, picked the properties you like, bought that day. But regardless, I think this is pretty good. Um, One of the things I want to point out, they're not stable, right? All of these are subject to having a bad month where there's a large repair, it eats up the operating reserve, and then for several months, maybe you don't make any money at all as the operating reserve is being replenished. Um, I really don't like how they do their math on that and the way that they treat them, because it does give you this false sense of like, hey, look, I have this amazing return. And then some months, oh, nope, I had one big problem and now I'm getting no return. And that's just not really how it works. But that's the way they present it. So, do I really, over the long term, I don't really know where these are going to end up. So far, none of them, none of the ones that I bought that were performing have had a problem, but at some point they will, right? I mean, you just don't have, um, they're just not accounting for it the way that, a normal real estate investor would just spread your capex and repairs and maintenance out over time. You just get hit with it in whatever month that it happens. And so your yields that you're seeing look weird because of that. And I will track what I bought tokens for, what I've gotten paid out every month, and eventually be able to give you better numbers on these. But at the moment, um, this is the math that I can do in sort of a reasonably expedient way. And so, somewhere around here, somewhere around a 14% yield. And like I said, I think if I really dug down and used my right basis and everything, I'd probably knock a couple percentage points off that. But regardless, it is, anywhere over a 10% current yield. I think I'm really excited about that. I mean, you're doing, uh, it's hard to beat that with any kind of investment. And then when you start to think about, well, and I'm going to get some level of appreciation on top of that, that's pretty incredible. Now, one of the things, and I haven't talked about this much in a while, but those yields will degrade over time, for any of the ones where there's an owner that has a mortgage in place and is paying down that mortgage, because the way that the ownership structure works on here, as they do that, it dilutes the other owner's shares. So that will happen over time. Although, it's a pretty slow effect. And, I think you could probably trade out of properties every few years and get into other ones if you wanted to, and really not feel that very strongly. I also was doing some math on, how much rents would have to grow to just completely counteract that, and it's not very much. And so I think it's possible if a property is in a market where rents are growing reasonably fast, you have a good operator in place, they may be able to maintain those higher yields as the ownership gets diluted. And that's something that's going to be, it's yet to be seen how that works out. The other thing I'm doing on here is lending tokens and a little bit of cash into their staking platform. And so far in there, my annualized return since starting is 8.42%. The way they do this math is really kind of wonky. It doesn't really take into account when you put the money in, and so, or it does, it annualizes it, but I don't think that it. I think when you just put your money in, yeah, I could be wrong about that. I'm not sure how, but you can see the number fluctuates quite a bit. So I had crazy high number early on. The lowest it's gone down to is 7%, but it's been hovering right around this for a little while. I'll continue to give updates on that and see where that ends up. But I think that some of this is actually double counting too, because it's adding some of this, or it's really, it's some of the tokens that I have, for example, that are getting decent yields are these same ones. Let me show you here. Where is it? Madison. I'm getting an 11% return on the staking and then the lower yield on here. And so, some of that is it's a little bit more income, although some of this yield gets diluted. If that doesn't make any sense, you can go back and look at some of the staking videos that I've done that explain, what's actually going on here. It's a little bit of a, if your only context is real estate investing and lending, this is just completely new to you. It was to me 3 months ago. I'm starting to get a handle on it now. I am staking most of my tokens now. If there's a liquidity pool, um, time will tell if that was a good decision or not. I'm not really sure. But so that's really all I want to talk about as far as returns go on Lofty. I think that I'll have to do a little bit more in-depth math as time goes on to really give you a completely clear picture. But I think this gives you a little bit of an idea, as far as what the potential is. My goal, has for all of the videos I've done is not to have like a commercial for Lofty or Groundfloor or Mogul and say, hey, look, I think you should do this. These are, they're fantastic yields or any of that. I've tried to focus on the due diligence of the properties, the things that to look out for, because I apologize for that. I froze up again. Really need to figure out what's going on with my screen. In any case, I was saying I'm trying to focus on the downside and how you do due diligence and protect yourself with some of these investments. And that's just because that's the way I look at real estate investing in general. I really believe, as you can see, I mean, the returns on here, if you're picking properties halfway decent, the potential returns are fantastic. And so the real issue that you have to look out for is to protect your downside. If you're able to navigate your way through some of these platforms in such a way that you're picking out properties that don't just crumble at some point, right? The chances are that you'll do very well. And that's the way in real life, when I'm buying investment properties, I'm just really looking for everything that can go wrong. I'm trying to, mitigate my risk as much as I can. And if you're, as long as you're in a market where you believe in a property that, you've picked out a good property in a good neighborhood, you're just going to make money in the long run, right? It's basically, and you operate it properly, right? Like, and that's sort of what you have to do when you're buying properties in real life. And so when you're looking at properties online, you sort of have to do the same thing, right? Pick out the people that are operating it properly. You have to vet the site, right? I mean, look, I'm still not 100% convinced that Lofty or Mogul are going to be around in 5 years. I feel a little bit better about Groundfloor because they've already had a 10-year track record and seem to have a reasonably solid business model. It's not that I think Lofty and Mogul don't have a good business model. They're just not as time tested. The reason I spend so much time on Lofty is because I think there are just some really interesting opportunities because of the secondary market trading. We've talked about that quite a bit. I also think the staking is an interesting way to just sort of juice your returns a little bit. And you are taking some risk to do that, but it seems like it's, in my mind, it's a very fair trade-off so far. So we'll see how that goes as it continues. But that's about all I'm going to tell you about Lofty today. Groundfloor. This one I think is a little bit more straightforward. Oh, what's happening here? Why can't I move that? Okay, well, there we go. Okay. You can see all the notes that I have. I think I have 58 outstanding. This is the breakdown of, the interest rates for each tier as far as their grades that they give them. And so right now my expected rate, my blended interest rate is 11.3%. whether or not of the one that's paid off, it was at an 11% stated rate and they paid at 11%. We'll see going forward how many of these fail, right? How many of them take longer to pay off, those sorts of things. So just because that's the expected and that's the contract rate, it doesn't necessarily mean I'll hit that. Although looking at all of their literature and past performance, it seems like, somewhere over 10%, maybe around 10.5% is very common on their platform, over a very long period of time. So it's very simple. This is one of the reasons that I think it's a platform that I'm more quick to recommend to people because it's very straightforward in what you're expected. There's no other return component, right? It's not like, well, maybe there'll be appreciation. No, it's just a loan you're making, backed by real estate. You're getting paid a certain interest rate on that, and that's it. Um, so I like it for that reason, but I also, I don't spend a lot of time on here because there's not a whole lot to do. You spread your money out across a bunch of loans. That's what I did. And, it's, well, about a year from now, I'll be able to tell you how that worked out on the first batch. Um, but so that's pretty straightforward, but I just wanted to share what that expected rate is. And then the last one that I put some money on is Mogul. So far, I've only bought one property. I got some bonus shares in another property. That's something they're doing. Really, they're giving you a lot of some free money and some bonuses, just because they're very new and they're trying to attract new investors. As I mentioned, all three of these sites I mentioned today, I have a link in the description below, where you can sign. They're all referral links, and so some of them you have to make an investment to get some money. I think the Lofty token you still don't have to. I think they just give you a free $50 gift certificate, just for signing up. For Mogul, I believe I had to invest money on here before I got the $50. I'm not positive. They might have given me that free. For Groundfloor, I definitely had to invest money. And then, but Mogul, but Ground Floor gave me additional income or additional bonuses for how much I invested, and so did Mogul. I think I said Mogul both times, so Ground Floor or Mogul both did that. So that's why I said I only bought shares in what Mogul calls 2809. At Rosedale, they call it the Axelrod. But I owned some shares in one other property. Now, this property just closed. It's not even, or it may still even be pending. I'm not sure. So all I have to go off of is what they're saying their cash on cash yield is going to be. But I did look into this. It was an operating Airbnb, and I believe they're going to buy it, and it's going to just, they might take over management. But it should be, I think, a relatively seamless process there. And so, I believe this cash on cash yield. Now they're talking about, higher IR, higher IRR. Um, and I think it's this is taking into account that there's going to be some appreciation over time. That's not something I really talked about at all on Lofty. Those are all different markets. It's not, they're not like I said. I mean, I think that you should expect some appreciation in those, and so then that'll be added to your return. But it's not a component that they're really tracking in any reasonable way on the site. And so I think that, um, until I actually sell out of properties, showing my IRR is going to be tough. But the same is going to be true here, right? Like until you've made a sale, you don't really know what your internal rate of return is. You can make some good estimations based on, 5 years from now, when we're sitting there, we know what the value in that market is. But until you've actually sold it, you don't know what that is, because you can never tell exactly what the property is going to sell for and whatnot. So in any case, what I'm really comparing is the cash on cash yields that we're getting in all of them, and it is, obviously this one is relatively high. It is a short term rental. It could fluctuate as well. It's lower. It's interesting that it's lower than the average of all the lofty properties. I think the big reason is the lofty properties have higher upfront yields because of their debt structure, but they have I'd expect to make less on the long-term appreciation from those properties, again, because of the debt structure, because you get diluted over time as debt gets paid down. And those properties where here the entity itself actually has the loan, and so you're not getting diluted. You're actually benefiting from the amortization of the loan. On the flip side, that's why the yields are higher on the lofty properties because somebody outside of those ownership tokens is who's paying for the mortgage payment, and so it's a trade-off of current yield versus your long-term value. Only time will tell which one's really going to work better. That's all I really wanted to share with you today, though. Just the three platforms that I have put money in already. I mean, this one really, it's not even a yield yet. I haven't, like I said, it hasn't paid out at all. So this is still just expectation. And, you could tell just as well as I can, if you're going to make it. Ground floor, sort of the same. I did have at least one of them pay off already. And so could see that came through the way I expected. But the vast majority haven't yet. And so only time will tell, how close to this expected rate am I really going to get? Um, this lending one it's a true return, but it is like I said, it's annualized, and so obviously, this isn't 8% of that yet, and I've only been seriously staking stuff for I don't know. I've probably doubled the amount I have staked over the last 2 weeks, and so again, this will be something that over time I'll be able to share more, and it should become more apparent, how real this return is in the long run. Whether it's going to be higher or lower than this, only time will tell. I think these ones, they're I think they might be indicative of where we'll be long term. Although some months, some of these will have to go down. I mean, there's just going to be capex items. There's going to be repairs that impair this income at some point in time because they're not accounting for it spread out monthly. But I think, especially if I develop a very large portfolio on here, um, that as long as it's not happening to too many of them at the same time, that effect it should be somewhat muted, depending on how long in between those happen. Um, and then as time goes on, I will give you updates on these zero yield ones that I've bought, what the actual returns I get when I sell them. But that's going to be, for another video. I think that, like I said, that's everything I wanted to cover today. So as usual, until next time, I'm going to keep making mistakes so that you don't have to.